Uh, I'm going to start off not by talking about this slide, but really just sort of diving straight into some of the a quick update on what's interesting and relevant to an AIM IHT portfolio service at the moment. I was just looking back. We've had a pretty volatile 6 months since we last did one of these updates. The first quarter was pretty dreadful, and market got itself very depressed into the Trump tariff terror, as we like to call it, which kind of culminated towards the end of March, early April. And since then, we've seen really a very strong 3-month period, and it feels like the market's really changed gear significantly in the last 3 months. And I think to many of us who've lived through some long market downturns in the past, this feels like the market's reached a turning point. Of course, you never know that. There's no bell that rings at the bottom of the market, but it feels like the dynamics of the market have become much more positive. And a little illustration of that this morning, we've had one of the stocks in the portfolio with just a reasonably positive trading statement. It was expected to be negative. It's gone up 24% this morning from a very low rating to just a modest rating. And that's indicative of a market that just feels heavily oversold and where sentiment's been very poor to some of these companies. On the legislation front, I think last time we spoke, we just had the slight shock of the November budget when really the AIM IHT benefits were reduced, and inheritance tax relief for AIM holdings was cut from 100% relief to 50% relief, and that's going to come in, I think, in April next year. The big question that's gone alongside that, really, and a lot of pushback to politicians has been, what about private companies? And what they appear to do is create a very non-level playing field, where all you have to do is make an investment in a private company and you got 100% relief up to £1 million. So a limit's been imposed on that, whereas in AIM that didn't apply. I think a lot of discussion has gone on about this. There was, as all the advisors watching this will know, that there are services up there that will just put money into private companies that are designed to take very little risk, and those companies will get you 100% tax relief and hand you the money back, and they're designed to be able to get liquidity in and out, and so on and so on. I think there was pretty little awareness in Treasury really about those services 6 months ago, and also in HMRC. So there's an ongoing question really about what view is going to be taken of them, and what action will the government take. Obviously it's not for us to sort of speculate on what might happen, but I think one aspect that anybody looking at those services really needs to consider hard is how do they fare under the anti-avoidance legislation for tax, and I don't know the answer to that. I know there are discussions going on to look at it, and huge amount of lobbying going on about it. How that all comes out in the end, I don't know, but that's certainly something to think about. And I suppose one of the things we were saying 6 months ago that's very good about the budget and the moves that happened to AIM is that for the first time AIM was explicitly given a tax relief, whereas before that it was always slightly accidental. Last November, the Chancellor stood up and actually said, yes, we recognise AIM gets this tax relief. We want to make it more modest, but we also want to have it. So buried in there actually was I think quite a big endorsement of AIM. Clearly, everyone's asking the question: is that going to change again? I personally don't think it will. I think it would be such terrible policy making to mess around with it again. Having said that, nobody from the government's come out and said this is now permanent. But then we're in such a state of flux, really, in policy making that even if they said that, would it be credible? It seems that decisions are few decisions are set in stone. However, it would be very, very perverse to change this again, and I generally don't think it will be. Incidentally, Kemi Badenoch, leader of the opposition, who knows what happens at the next election, but she has come out and said that she would reverse the BPR changes, So they're definitely not going to reduce them any further if there's a change of government to the Conservatives next time. So this feels like it's good. Longer term, this turns into something of a positive, and it feels like the whole regime of what benefits you get for holding AIM stocks should become a good deal more recognised and more stable going forwards. So that said, lots of people always say, you shouldn't let the tax tail wag the dog. Is AIM fundamentally worth investing in? And this is a key question. So starting just a very few quick slides here, which I'll then invite Scott to come in and tell you more about the portfolio and how we manage it and what's been happening. This is just the long-term view, the classic sort of UK small company effect, as analysed by a couple of professors from the London Business School over a long time, showing that you do get paid to buy small in general in stock markets, and that's been particularly true in the UK. And you can see here, even after such a torrid time for small caps over this long period, there's a clear differentiation for buying small over in the long run. This is a quick analysis of some bear market drawdowns. So in recent years, small caps have fared quite a lot worse than large caps, and this does happen in the market. And in fact, it happened in the early 90s, shortly after the small companies effect first paper was written in 1988. There was a long period when large caps outperformed. It didn't change the long term, however, and that didn't last for more than a few years. And that's what we've seen here, a few years of, if you like, contra trends in terms of large caps outperforming. I think Scott and I pretty firmly believe that the small cap trend is going to reassert itself probably fairly soon. This is looking more at the shorter term, shorter medium term, what's happened to AIM. So this has been in the headlines a lot. AIM has badly underperformed even the kind of fully listed small cap and mid cap end of the market. And what's been going on here, and you can see particularly the 3-year returns are a million miles away from the mid cap returns. So there's two factors here that we need to consider. One is, of course, are all AIM companies rubbish, and this is just a kind of to do with the companies themselves, or are there other factors that are affecting companies that particularly companies on AIM rather than on mid cap? And there are, and we're going to come back to that. Or rather these other effects. So in terms of the quality of companies, I think AIM is a mixed bag. It's always been a mixed bag. There are some pretty poor companies that get onto the market. There's some very early stage companies that get onto the market, and those are by definition much riskier. But also there has been, and I think will continue to be, a significant chunk of stocks which are just really decent, solid, small companies, and in many cases, really decent growth companies. And those are the ones that we're really looking for. And we have particular characteristics that we look for in this portfolio to steer us slightly towards the more conservative end of the market. And those companies, there have been a few effects which have really hurt because of being on AIM, and obviously the budget last year, the big change, reversed what was a very positive liquidity dynamic on AIM, with some money coming in almost every day into AIM portfolio services. And if you like, in some ways, AIM was, because that's changed, AIM's been partly a victim of that in the past couple of years, where uncertainty crept in, and then the budget changed, and we've had all kinds of upheavals. Money's been flowing out of AIM. There's no longer a steady influx of liquidity all the time, and the markets had to find a new equilibrium. And that's really what went on in the first quarter. We've also seen this effect where some companies announce they're going to leave AIM just to list because they've been convinced that AIM doesn't have the same future that being fully listed does. I think Scott and I are really pretty convinced that in anything other than the short term, it doesn't make any difference at all, really, whether you're on AIM or on the full list. It's a bit of a pointless exercise, and we certainly encourage companies not to waste their time and money on doing that unless maybe they're over £1 billion plus, and there's very significant reasons for not doing that. Interestingly, the example we had the other day of Rosebank raising £1.4 billion from global institutions and really large global investors on AIM, really belies this fact that nobody can invest on AIM. There's this great, supposedly the great reluctance to do it. We just don't see that. And in any case, there's quite a high degree of fungibility of money between AIM and the full list. So if money goes into the mid cap, prices rise, that it's only a matter of time before that trickles down to ratings on AIM. So we have seen, I'd say, a 6-month quite severe distortion, and that's now beginning to unwind. And the pathway between those companies which are delisting on AIM and moving to full list are now finding that, that there's becoming a sort of well trodden path for doing that, and companies are getting a bit smarter about how to do it. There's more to learn, and there's more there's more process to go through to make that a slightly smoother process. But some of the big negative effects we're seeing in Q1, and they're beginning to unwind now. The fund flows in the UK have still been negative, or they were still in April. This isn't the only picture. So fund flows are one thing, and we don't think fund flows have really turned positive yet, although I do think markets are self-feeding, and it's important to remember that. So if good performance carries on at the smaller end of UK small cap, that's going to attract money in the near term. But over and above this, there's the whole pension fund arena, where pension funds have been withdrawing capital from UK stock markets, full stop, large and small cap, for 20 years. That feels like that's being challenged now, and we did see one of the first instances where a large group of local authority pension funds put 1.4 billion pounds into UK small and mid caps in May. I think that happened, and we've seen the effect of it. The impact has been pretty substantial. So we think there probably is more to come on that front, and that's what's beginning to change the dynamics in the market overall. This is just looking at the UK in comparison to other markets, and actually we can see that year to date this is emerging to be quite a positive story now, and the dynamic has changed. And then finally here we've got the alternative markets in the short term over 1 year, still lagging, but actually this picture is evolving quite rapidly, and the most oversold market, which was AIM, is now fairly rapidly, it feels to us, fairly rapidly re-rating back upwards, as we've seen in that company I was talking about this morning, Volex, where we've seen a very sharp move just on a piece of mildly positive news. On the UK economy, there's we could put up lots of slides here. The surveys are still mixed, but you can see here real disposable income is maybe the standout feature. And while we've got a big problem with government debt in the UK and a very ropey government balance sheet, and remember a lot of the government debt is off balance sheet, so the debt is bigger than it looks. Offsetting that is the fact that consumers in the UK, households in the UK, have a very high proportion of savings, and the savings rate's been high for a long time. So household balance sheets are strong, and really that is underpinning the economy at the moment. And finally, on this section, the money supply, which is something we keep a pretty close eye on with the help of the Institute of International Monetary Research, who publish this data every month. You can see here that after a huge volatility between 2020, beginning of COVID, and really the end of, and 2024, where money supply was all over the place, and you can see the annual rate went below zero in 23, which is really what brought down inflation very sharply. It's now normalized right back to 5%, and 5% is kind of the sweet spot for UK money supply growth. And actually, even though a lot of other figures might look quite scary, this one tends to be incredibly strong in terms of determining outcomes for markets and inflation and the economy overall. So actually, we take a good level of comfort from this normalization.